Welcome to the Cashflow Academy YouTube page. We're going to go through MSTY, these high yield, what they call YieldMax ETFs. They are a very popular product today. We're going to talk about some of the flaws involved with them, expense ratios, things of that sort, and there are some things to be aware of. So before we get into that, make sure you hit that subscribe button so you're notified and able to take advantage of the free education we put out on this YouTube page. So MSTY is the stock symbol for one of these YieldMax products, and there are YieldMax products on a variety of different stocks. So how does it work? Well, basically they produce income in the form of options, and they bring that income back to the shareholders. So they're paying out massive yields, like it's called yield max. But these are what I would call junk yields. And I want you to be clear about why that's the case. So if we look at MSTY on a daily chart, you'll notice that this stock has been going sharply lower. It has been going from about $25 per share down here to 17 of late during the popularity phase of these. Now that's a big capital drop. $8 move lower from 25. That's a big percentage move. Let's see what that is. 8 divided by 25. It's lost about 32% of its value just since May, and we're here in August. Well, why is that the case? What these are doing is, this one specifically is based on a popular stock, MSTR. MSTR MicroStrategy is a company that invests in Bitcoin. So they've been issuing shares, taking the proceeds of the shares that they sell and buying Bitcoin with it, and doing these things to generate a return. So MSTR, you can see that its share price has gone down, not in the same magnitude as that MSTY. MSTY is an ETF built based on MSTR options. So here's essentially what you're doing. When you're buying one of these YieldMax products, you're just paying someone else to do option trades that you could be doing yourself. And the expense ratios on these are sky high. Let me see what the expense ratio is. What is the expense ratio of MSTY? I should have had that handy. I've got my chat GPT here. A gross expense ratio of just basically 1%. So you're paying a 1% fee. That's pretty darn high. Think about it. If you had $100,000 that you are managing, you're spending $1,000. That's 1% of that just in fees. Is it worth it? Well, not if you know what you're doing. You could create the same thing. What they do is essentially a covered call like strategy, just something where they generate yield. And why do they do that? Because the options on something like MSTR, MicroStrategy, are sky high. Look at this. Stock at 345. If I was to buy the stock and sell the at the money call that expires in 3 days, not in 3 months, in 3 days, the at the money covered call would pay me over $8 a premium. What type of yield is that? Well, that's 8. It's over $8, but let's call it $8 divided by its share price of 345. I'm generating 2.3% in 3 days. I don't even want to annualize that because that's ridiculous, right? That's earth-shattering. Well, what if we went out to the next week and we sold the 345? Now it's going for $14. $14 divided by 345. Well, now we're up to 4%. The yields are sky high, but why are they so high? Because the shares are so volatile. So you get what you pay for, right? You get based on risk. So there is a truism in the options market. The options market is very much like insurance. We could draw a teeter-totter. That's not a good color. Let's change the color here. We could draw a teeter-totter. And as we stack something on this side, it's going to make this side go up. And vice versa, if we were to stack weight on this side, then this side would go up as that one goes down. That's basically how risk and reward and probability works, right? So in insurance, they say, how much risk am I taking? And I need to be compensated due to the risk. So if I'm going to insure a car against damage, if I'm Geico and I'm selling car insurance, they say, okay, 16-year-old boy, I need to be compensated with more premium. I need to be paid more. Why? Because my risk over here is higher. My probability of success is lower, right? My probability of him crashing, of him not crashing, let's say, is very low. So my risk is higher. I need to be compensated for that. But if they were to sell insurance on a little old lady that's never been in a crash, well, now their probability of success is very high. Their risk is lower. They can accept lower premiums. And so there's that trade-off. The reason that these premiums are so high is because of the inherent risk of this stock. It's a very volatile name. So, who should be trading MSTY? Well, the same people that are trading MSTR. It's just a different vehicle. This is just a YieldMax. It's them saying, oh, we can go take these huge premiums and people won't know where we're coming up with them in essence. Now, they do some strategies that are basically covered call. They're not doing actual covered calls. I believe what they're doing is what we call synthetic covered calls. So in the options market, a synthetic means that I can create the same structure, but in a different way. In fact, if I sell a put, that's equal to selling an at the money put is equal to selling an at the money covered call. They are synthetically the same trade. They'll produce the same risk graph. So in the options market, we can get to two different strategies in a couple of different ways. They may not be doing standard covered calls, buy the stock, sell the at the money call, but they're creating a risk graph and a risk and reward and a probability that's the same thing. There's really no advantage to paying them 1% assets under management. That's a high expense ratio. That's a big fee you're paying. So, will you make money? Well, you're going to make money if MicroStrategy is fantastic as a business. If its share price goes higher and higher. What's it dependent on going higher and higher? Well, Bitcoin. So if you're a big believer that Bitcoin is going up, up, and away, then MicroStrategy will probably participate in that. And MSTY will probably do okay. But here's the damnable misery of the market. However good Bitcoin does and MSTR does, you're always going to do a little worse in your position here in MSTY. Why are you going to do a little worse? The same reason that every mutual fund owner has found out, they seem to always do a little worse than the S&P 500. Why? Because basically most every mutual fund just builds a portfolio that mirrors the stock market. And so as the S&P goes up 10%, the mutual fund goes up 10%, but then whoops, you pay them a fee, and so you only went up 9. MSTY is going to work much like that, where you're going to consistently underperform what you could be doing at least on your own if you knew how to utilize these strategies. If you knew how to do covered calls and short puts and create synthetics, you could do the same thing if you were a believer on these. Now, I'm using MSTY because it's a very popular YieldMax product. There's others. As you can see, I'm not a huge fan of these products because when you start paying massive expenses, you make Wall Street very rich and you always seem to get the bottom end of the barrel, right? You don't quite get what you should have gotten. And I guess the old saying, if you always do what you've always done, then you'll always get what you always got. Well, maybe that's applicable here. If you continue to buy products where you pay high expense ratios, you're going to underperform what you could otherwise be doing. and you're going to fall into that trap that so many people do. So, hope you've been enlightened on how some of these YieldMax products work, some of the downside to them, specifically expense ratios and just overall risk. They're literally picking the stocks with the biggest premiums to create these products on. And even more to the point, basically the net asset value. Why can they guarantee yield? Because the net asset value is depreciating over time. And the value on these products will go down over the long term. And what happens when they go down dramatically? They'll do reverse stock splits. And a big warning sign whenever they do a reverse split, you know that something is junk. Well, there's some other products, some other ETF type products that there have been reverse stock splits on. If you look at something like USO, you think, oh, this probably just tracks oil prices. No. Is oil down this dramatically? Did oil ever trade to $300 a barrel and now it's at 74? Heck no. The reason this is down from $300 a barrel in 2015 to its current share price is that constant devaluation, that loss of value in some of these ETFs that charge high expense ratios and are built to basically lose net asset value over time. So there's a who's who of not to touch ETFs, and they would be things like the VXX and the UVXY. These are terrible products. USO and UNG, these are terrible products. MSTY and all these YieldMax, these are terrible products, and over time their value will depreciate, and the probability that investors will end up holding these for any extended period of time and make money is very, very, very low. The probability that you will lose money holding these for a long period of time is very, very high. That's not where you want to live. Reverse that to thinking about the stock market. If you own the stock market for a long period of time, your probability of making some money is very, very high, and your probability of losing is very low. That's where you want to live. You do not want to live in the low probability of success, high probability of losses, and that's what a lot of those ETF products give you. So, hope you enjoyed this one. Now check out this next video for more content that you are going to learn from and be able to apply to your own investing and trading that you're doing.